stock market crash is something that happens periodically most time because of what is happening either in the global economy or in the economy of the country where the market is located. So macroeconomic issues affect the market. So like we had the pandemic in 2020, it affected the markets across the world. We talked about the economic meltdown in 2007, 2008. It affected stock markets across the world. So such things are bound to happen. One thing about crashes cannot be stopped because different things cause those crashes. But one thing that always happens, the market have the opportunity of bouncing back. And for you to avoid the impact, you may not be able to avoid the crash like I mentioned, but you can avoid the impact of the crash on your fund, on your portfolio. One step you must take is that in investing, you must learn to diversify your portfolio. Diversification means not putting all your eggs in one basket, not putting all your fund in maybe in a particular stock or all your fund in a particular sector. When you put them in different sectors or in different stocks, it means that if there is a crash, if there is a negative impact in one sector, the other sector will help to even out that impact. So one way to avoid the impact of crashes is to diversify your portfolio. Another thing you must always do is that some persons invest and they just leave the investment and not following up on their investment. Once you are invested in a particular stock, you must be following up on that stock, following up on that company, so that when you'll be able to get information of any occurrence before it materializes, before it affects your investment, you can take some action to reduce the impact it will have on your stock. Another thing you can also do as an investor is the fact that once you have invested, you must also look at putting your fund beyond putting it in stocks, a different stock. You must also look at putting your money in different asset class. That is also part of diversification. Outside it, we are talking about diversification within asset classes. You can also have diversification outside the asset class. For example, rather than just putting all your funds in equities, you can also put your funds in fixed income instruments. That helps to protect your investment. I'll give you an example. When you currently we have experienced a lot of rate hikes by central banks, which has resulted in increase in the rates in the fixed income space, whereas the great return, the equity space have experienced a bearish run. So we have seen the equity investment losing their value, while we are seeing increased rates in the fixed income space, appreciation in the increased return in fixed income space. So when you have the investment in both the equities and fixed income, and also sometimes derivative and other alternative instruments, it helps to even out your return, especially for areas that are experiencing negative return. So one way you can avoid the impact of a crash on your investment is to diversify both within the market and in different asset classes. Thank you.